Hello. Welcome everyone here and both virtually to our fun little seminar we have today called The State of the Economy and Key Business Impacts. We did a version of this at SMU Startup Week last week, which was super fun, and so we look forward to kind of continuing this discussion and encourage anybody to reach out both after the session in person or online via our website if you have any follow-up questions. I'm going to moderate today. My name is Danielle Wilbur. I work with this very talented team of individuals, representing them as head of sales and new business, which is a very easy job when you work with very smart people. I have been in sales and marketing for a little over 15 years now, and I've kind of found my niche in the financial sector, which is where I have the most fun. So I'll intro everyone here today, and then we'll get cracking on the topical important issues at hand. First to my left, I have Mr. Chaz Hart. Prior to joining the SMART team, Chaz worked as a solutions specialist and an analytics manager in the supply chain planning industry. He's been with the team since 2019 and is our senior strategist. Chaz isn't just a CPA, but he's a brilliant architect of advanced enterprise level forecasting models and is very, very skilled, I know firsthand, at creating beautiful Power BI and Fathom reports that provide very invaluable insights into the operational workings of our clients' businesses. So welcome, Chaz. To his left is Kellen Jameson, also a CPA. Kellen has spent 12 plus years leading accounting and finance teams, specializing in driving profitability and finding intersectionality between operational data and financial insights. Kellen has helped build SMART from the ground up with our founder, Clint Bowers, and is now the director of all client delivery departments, including tax, accounting, and financial strategy. Kellen also personally spearheads a lot of the M&A work we do for clients, needing anything from quality of earnings calculations and business valuations. So welcome, Kellen. Leah Resnichek to his left is our HR gal with 10 plus years of experience in human resources, and prior to joining the SMART team last year, Leah helped global tax firms and burgeoning tech startups build their teams and empower their staff. She is expertly skilled, again I know firsthand, in all areas of HR management, including curating new people-focused processes, compensation and benefits design, training and development, talent acquisition, and employee experiences. So thank you, Leah, and welcome. And Hampton Honeycutt, which is my favorite name of all time, is our tax guru, also a CPA, has over a decade of experience in tax work, exclusively and specifically, doing everything from everyday tax returns to complex tax projects. Hampton joined the SMART team also last year as our senior tax manager, and has held prior roles as assistant and senior VP of tax for Cadence Bank, as well as a corporate tax officer for Regions Bank. Hampton is frequently on the hunt for new tax opportunities for our business clients that help them either mitigate their burden or uncover untapped potential benefits. So welcome, Hampton, and I'll start off with Chaz without much further ado. Chaz will be kind of our resident economist for the day. And, Chaz, I think that it's, I guess now more than evident, but there was some debate about whether or not we were in a recession. From your sources and kind of your take, what would you say, are we or are we concretely in a recession as it stands now?
Yeah, good question. I'd say it's complicated, but at the traditional term of the word, yes. So typically, the way that a recession is deemed, whether you agree with it or not, at least historically, has been 2 straight quarters of GDP reduction. This last quarter, it reduced at an annualized rate of 0.9%. So there was a reduction before that as well. So in that sense, it is a recession. It is a little bit debatable though, in the sense of when you kind of look under the hood, and we'll kind of look at that a little bit later, there are some interesting dynamics that are going on within the economy that if, for instance, some odd inventory action didn't happen in this last quarter, it wouldn't have actually been negative. So there's a little bit of devil in the details there.
Okay. So, yes, statistically speaking, or historically speaking, we are in a recession, but there's nuance, so, okay.
Yep.
Will we, I think the second thing that everyone wants to kind of know the short answer to is, will we see inflation continue to do what it's doing now and to kind of be on an upward trajectory, or will it level off in the near to immediate future?
Sure, and that may actually depend on which inflationary measure you're looking at, right? So typically when it comes to most inflationary measures, you have kind of a basket of goods. But within that basket of goods, there are certain elements in it that are historically much more volatile. So if you take CPI, for instance, that's the main one that everybody kind of reports on, right? That measure has a component of that is energy and food. And both of those, if you look at a chart of CPI less energy and food and CPI with energy and food, you can kind of see a somewhat level inflation, and then you have this kind of undulating inflation alongside it, right? So if we look at that in and of itself, core inflation likely has a little bit farther to go, and I have a few reasons why I would say that. But the overarching inflation may actually come down some, as I'm sure everybody's seen at the pump. Certain gas prices have come down from really what it measured at last month. That energy component has been a significant driver in that inflation. So
interesting. So speaking of drivers, so what would you say are the main economic drivers of this particular recession, say compared to what happened back in 2008?
Yeah, there's a lot of differences, and that's really where the debate comes down to. If you look at the market as a whole, really if we're taking GDP as the measure of a recession, right? Kind of going back to that initial conversation about 2 straight quarters of contraction. We have this chart that really does a fantastic job of showing the various components of the economy, and we can kind of talk through different nuances within these components.
And you derive this data from, which is your source, kind of?
Yeah. So the last GDP report. Okay. So they're quarterly reports, and this has Q1, which I believe is blue, and Q2, which is red.
Yeah.
So when we break down the GDP report, which is really the measure of the economic output of the economy, it really goes into a few different segments that are kind of summarized on this page. So starting with the first two, that's your goods and services that are involved in the personal consumption. So when we think of the American economy and the really one of our strongest suits, whether you like it or not, is the consumers. We spend a lot of money. Unfortunately, from a savings rate perspective, historically it's in the high single digits, sometimes in the middle single digits in comparison to some other cultures. It's just different, right? Right or wrong. So that's a significant driver of it. And when you look at the combination of just the consumption side of things, we have some degradation on the goods side of things. It was down 0.08 as a contribution to real GDP. So think of it in the sense of if GDP was only measured by these line items, that's what the contraction or increase would be for that given quarter. But on the flip side, we have services that increase 0.78. So if you take consumptions as a whole, there's really 2 nuances in that. Consumptions as a whole, they actually increased for this past quarter. And then the other nuance that we're kind of seeing there is the goods are kind of pulling back. So you're starting to see some of those various signs of a recession there, but services are still on the upward trend. We do have to consider the fact that when COVID happened and the lockdowns, they did get hit significantly harder, right? But at this point, when you look at where they're at in comparison to that, they're more or less level. So it's still worth noting as far as that direction.
So it's not just a bounce back, it's actually a bounce back plus growth.
Yeah, we're starting to see that moving, and you're going to see a lot of reflection in a recession. That demand starts diminishing, right? So the next side of this, on the fixed investment side, that's when we start talking about the inflationary measures, right? So when inflation starts going higher, the Federal Reserve is going to kick in and start trying to stabilize prices. So I know we'll talk about the
Jobs starting.
Yep. I know we'll talk about the job side of things later on, but the Fed's really only after two things. That's their main mandate. You could argue a few other things, but it's to maximize employment and to stabilize prices. So we have this dynamic where unemployment's at historic lows, and if that's going to be the case, then there are other options, but they're going to try to maximize and stabilize the prices. And the way that they end up doing that is by increasing the federal funds rate, which in a very abbreviated version of that, it's really the cost it takes for the banks to borrow. And when the banks lend out $100 per se, they're not going to have the full $100 in deposits. A portion of that they more or less borrow. So at that point, when their cost of capital goes up, that then moves into the market. So then mortgages start becoming more expensive, or buying equipment starts becoming more expensive. And those interest rates cause a second thought on the demand side of the supply and demand equation when it comes to the economy, which will then tamper some of that. That's what we're really seeing in this fixed investments, because that's both residential and commercial. You can see that contraction of 0.72 in this latest quarter. Now, obviously, there's more that goes into that, but you can kind of assume it's costing more for people to use loans, because most people aren't buying equipment. If you're running a manufacturing business and you're buying a $300,000 piece of tire manufacturing, yeah, you're not paying for that in cash in most cases. You're going to finance some of that. If that costs more, yeah, you're going to think twice about it. And really, the last thing on that's fascinating is change in private inventory. So I'm sure it's kind of been in the news, but this really has to do with the bullwhip effect. So I'm sure Target was the main one, right, that came out with this, but all the main conglomerates kind of did this, is we have this searing hot demand that was occurring on the good side of things, coming out of COVID with a lot of the
Toilet paper.
Yeah.
Hot demand. Right, got it.
Yeah, even that, but all over the place, right? And when you think about the people up in the corporate office in Target, I'm just using them as an example, they have to plan for what needs to hit the shelf 15, 30, 45 days, depending on the type of the supply chain, what level of inventory. So what happens in the bullwhip effect is when there's a change in demand that then shifts what those goods should have been, by the time that those are hitting the shelf, they're over capacity or really overstocked. And this happened with, I believe Target's was summer like patio equipment. So then all of a sudden, what that ends up causing is huge sales. Yeah. So huge sales to then clear out this inventory, but it also causes a reduction in the amount of purchases that you're seeing, and that's where we're seeing that 2% kind of loop it back in on that side of things.
Makes sense. Going back to kind of the Fed's involvement, and Kellen, speaking from what we're seeing on kind of the client service side of things as the people behind their finances, specifically, you can kind of talk to small and mid-sized businesses, but specifically with startups, people, businesses that, rely heavily on these funding, or the Fed funding. What have you seen happening kind of in the latest economic trends, or what's happened there?
So speaking first from a startup standpoint, and then sort of just an equipment financing leverage standpoint, two things that we're seeing on the startup front is a combination, like Chad said, everything is happening all at once, and things that used to be sort of negatively correlated are all of a sudden positively correlated. No one knows what to do. And I've said several times, like in 5 years, there's going to be people getting PhDs on COVID economics specifically. But But what we're seeing in the startup world is competition and really profitability mattering earlier than what's typical in this world. So if you think about what's occurred, a lot of companies start, most companies fail. Not many companies actually failed, or not as many as probably ought to have during COVID, because you had things like the PPP CARES Act, the EIDL loan, COVID getting moved under an emergency category. So there's a lot of cheap, readily available financing for businesses that probably should have died anyway, right? So we've started calling them just zombie companies. So what's happened now is that financing has run out, that runway that was a little artificial has run out, and now there are just less startups right now. There are less kind of new companies that are willing to take on investment or sort of hitting that crescendo point where they're ready to raise a Series A or B. And so you have now these VC funds and private equity groups and investment banks have a lot of cash right now that are being devalued by inflation, and a shrinking pool of investable startups that are worthy investments, right? So if you're now competing for more investment proceeds, what you start to see is as the federal funds rate increases, the distance between a very safe treasury bill investment and a very unsafe speculative investment in a startup, that margin is shrinking, right? So now you've got to be a little more attractive from a startup standpoint. You have to be profitable earlier. You have to know your numbers inside and out. You have to be able to speak confidently and clearly to the numbers. And you can't really raise $20 million on the back of a Excel model anymore, right? They're going to want to know, okay, what are your daily active users of your piece of software? Are you just pricing this? The most cliche thing in the world in our space for a long time was, some private equity investors saying, how many daily active users do you have? Or have you gotten this to a subscription model? Really what they want is lower prices, higher customer counts. They want to know how much of the market you're addressing. Those questions are shifting. It's not just, are you charging $200 a month? How much more reach could you get if you charge $150 a month? They want to know now, if you have a service that really works well and really performs well, can you charge a onboarding fee for $1,000? Can you charge a successful efforts fee if your software really does solve the problem? And do you know what your customers' problems are? What they want to see is sort of a cash flow curve with your customers that's a little different. So you have an onboarding fee, subscription fee, and then a successful efforts fee. So let's say 20% of whatever problem solved you get as revenue. So they want to know that you can negotiate things like that with your clients. They want to know that you have a plan for profitability, not just for unit growth. And it's something that really sets you apart as a startup versus a good idea of a bunch of guys in an office, wearing shorts and playing foosball, right? So it's getting a lot more traditional business fundamentals are mattering, whereas in the past it was kind of how fast can you get 1,000 daily active users. That's kind of what we're seeing in the startup space. In the general sort of business space, we're seeing a delay in good ideas being realized. So employment is very low. People think, oh, we have a low unemployment rate. That's fantastic. That's very harmful for an economy, especially the U.S. economy that's highly innovative. Because if I have a fantastic idea and I can't hire anybody to do it, because right now, correct me if I'm wrong, there's 2 open jobs in the United States for every two individuals for every open job, right?
Yeah.
So if you've got a great idea, it's a little harder to get funding, and it's almost impossible to hire people. So you sit there on your couch with your good idea for a little longer than you might have otherwise. What you're also seeing, and this is 2 things that used to be negatively correlated and now positively correlated, is I used to sit in my factory and say, I can't hire these 100 people that I need because there's 2 people for every open job, or sorry, 2 open jobs for every person. I'm going to go buy a piece of automated equipment for $300,000 that solves this problem for me without the headache of having to recruit and hire people. But now financing costs has gone up. So now I'm having trouble raising the money to get this this equipment. Now I need to go, I need to sign a personal guarantee. I have to raise a fund to get investment to purchase this equipment. I have to clear a higher rate of return on the equipment before it makes economic sense because the cost of capital is going up. All of these things are moving together. It used to be salaries are going up, replace with equipment. Now it's salaries are going up, can't really replace with equipment as quickly as you might have otherwise. And so there's a lot of good ideas that are sitting on the shelf right now because that demanded rate of return on the investment is getting more and more difficult to achieve. That's what we're seeing right now in our business.
I'm going to circle back to that because I have a follow-up question, but Leah, since we talked about the 2-to-1 reality, I know that we are not, we're not, immune to the struggles there.
Not only are we not immune, we're squarely across the
So, if we're looking at apples, and let's say price isn't a factor, and I'm a small or mid-sized, I'm an SMB or I'm a startup, and I know I have to hire people, and I know that I'm still maybe competitively priced for what that position is. What are some factors that are actually proving to give us an edge that's not just about price today, and or does price win out every time still, and it's still a numbers game?
Yeah, price helps. Don't get me wrong. Compensation is going to be one of those factors that helps people determine if it's the right fit for them or not. But it's not the only factor, and there has really been a shift in kind of worker priorities as the economy has shifted too. So from a company perspective, really the most important things when you're looking to hire somebody on is to make sure that you can clearly articulate your value proposition to potential employees. People think about their value proposition as a company, right? What sets me apart from this other organization? But it's also really important from a people perspective. I was reading an article a couple hours ago, and it actually divided this into traditional and non-traditional value proposition offerings. So what sets you apart from a traditional perspective? That's going to be your compensation that you offer, bonus plans, benefits, those kinds of things. But to your question, it's not just about that. Those non-traditional things are what are causing people to move from one job to another, or people who have been out of the market to come back into the market. And those non-traditional things are going to be, what meaningful work do people get to work on? What new technology do they get to leverage? Automation is a very relevant topic in the workforce right now. So what automation do they get to be involved in? What are some of those non-traditional value proposition factors that set you apart? So being able to effectively articulate that will help you win out from some of the people who are offering more comp. There's more to it than that.
Do we feel like that's a generational? I know that people like to say that's a generational thing. Does your experience reflect that, or do you see it across the board that it's younger and older people that are wanting more purpose and meaning out of it?
Yeah, I would say there's a heavier focus with a younger generation, but it does really span kind of different generations in the workforce. Again, the reason that people are moving from what they consider one traditional job, which is working, say, in a financial services firm, to another traditional job, going to a bank or something like that, is because of the why.
There's a little bit of an Instagram effect we see, right? So there's an accountant, a 25-year-old accountant that gets to say to their buddies or having a beer, hey, I booked 16 journal entries today and I reconciled an AR with it, right?
Yeah.
And then there's the one that gets to say, well, I'm working on a quality of earnings analysis for a software company that's getting ready to sell for $2,500, right?
That's sexy.
That beer tastes a little better, right? So that's something that we have to do, is we have to pull our newer employees up market faster to keep them interested longer. That's something that's very, very important for us right now, and something that's top of mind. Something, we sit down for 10 minutes and focus on, at least I do every day, is, we we have an employee that's been here for a year, how do we make it a little more interesting, right? So that's something we have to be cognizant of.
Yeah, and that's a great point. Not only how do we make it more interesting, but how do we make sure that they know that this is something different than other organizations may offer, right? Being able to articulate that and explain kind of the value and the meaning behind what they're doing and the interest behind what they're doing is going to get people more hooked and bought into to the meaningfulness of it.
It's massive, right? So now, going back to Helen, I know we kind of talked about the startup world and kind of how some of the economic conditions are impacting them specifically. From what you're seeing from more established, profitable, successful, kind of, they've been around 5+ years, they say, maybe less or more, SMBs, how is this economic climate specifically impacting those businesses, and or what takeaways from this climate do those businesses need to keep top of mind right now?
Yeah, the one thing we're telling everybody is get your pricing increases done now, because first thing is your prices are increasing, right? The producer price index is dragging the consumer price index upward. So if you're a producer, you should be charging more because you send an email to that CFO or the CEO, whoever is the stakeholder in that your client's organization that approves, controls the purse. You're going to be the 5th, 6th, 9th email they've gotten that month with a price increase. If, however, you find yourself not needing to raise prices, you're actually doing really well and you want to grab more market share with a lower price, send that email too, but give yourself credit for that. Like, if he's getting 9, 10 emails that month raising their prices, there's value for you being the one email that says, hey, we're not raising your price right now. We value the relationship. We're doing just give yourself credit, right? So either way, send it in an email, either with the price increase or credit for not raising the price, because that is equity and sort of relational goodwill that is valued and cash in later. So that's something we're seeing a lot of benefit to our clients is who can you raise prices on, what makes sense, what's served. Now it makes more sense than ever to do like a SKU rationalization study, right? If you've got 10 things you sell, should it be 6 or should it really be 2 probably? If you follow a normal Pareto distribution. What makes sense to raise the prices on? What clients, do you need to find another home for in a delicate relationship-based way? That's what we're seeing now is because inflation is going up, right? And so that's pulling the producer price index, that's pulling up the consumer side. And so, you may have an employee that walks into your office the morning after an 8.63 inflation report and say, I would like an 8.63% raise, right? And so your costs are going up, your people costs are going up. So you have to respond, you have to raise prices, you have a little bit of cover to do that right now. You don't do it, make sure you get that credit as well. But don't not do anything right now based on inflation.
So Chaz, I was gonna say,
So can I add a little?
yeah, I would.
One thing that you touched on there that's really interesting is as we're seeing the old rules still follow from an economic standpoint, but we are seeing modifications to that with social media and some of these different concepts. And one of those around there is the concept of the overarching narratives impact on people's decisions. So from the concept that you were talking about there, inflation, this is one that's actually been studied a little bit, but we're seeing it really kind of all over the place. If the overarching narrative is, hey, inflation's coming, don't keep track, or don't keep cash. I was thinking cash is trash. Don't keep this. If that's like the overarching thought that everybody's talking about, right? When it comes to your own personal decisions, you're like, okay, well, if I keep this money, it's going to be worth less, so I'm going to go spend it, right? From the point that you're talking about on the pricing side of things, that's the easiest time when it comes to increasing prices is when everyone thinks costs are going up anyways, versus if on the flip side of it, whenever a full-blown recession really does happen, that's actually an inflationary event, because if you think of inflation and a supply and demand dynamic when a full-blown recession happens that reduces the demand side of things and typically increases supply, which just pushes things down. So when that happens, if you didn't raise your prices before, then you're kind of out of luck. And the other aspect that I want to talk on, you were mentioning the T-bills. What that does on a valuation aspect for current businesses that are profitable is that your valuations are going to be much more favorable in comparison to a pre-revenue or earlier revenue startup, because that discount rate, when they're bringing that back to present value, is going to be higher, that hurdle, in order to spend that money. So those that are making current day cash flow versus future cash flow have a bit of an advantage when these VC funds ultimately want to bring in or they need to place their money, right? So at that point, that's something to consider as well. If you are a profitable business, there's some opportunity to talk to some of those equity raises.
Yeah, and if you are profitable, and you are one of those companies that does have cash flow today, it's worth more than cash flow tomorrow to a ever increasing degree, and you have a good plan for growth, you have a little bit of pricing power with your customers, you do maybe have the equipment on hand or have secured financing for your good ideas as a business, then start to dictate terms a little bit to these investors. We've seen a lot of people kind of get in the room with a money investor and sort of wilt a little bit. These guys are smarter than me. Well, if you have a profitable business, they need you more than you need them at this point, because they're having a hard time finding things to invest in right now for all the reasons we just discussed. So maybe you don't open up the cap table quite as much. Maybe you do go after the debt markets and not the equity markets. You get a little more aggressive in getting what's best for the business, and not just chasing the dollar to get in the door, because all you're only worried about is a 13-month runway. So you get to be a little more aggressive and stand up for yourself a little more in today's world if you checked all those other boxes, right?
Hampton, I know that you are in the middle of tax deadlines and have a newborn, so you probably not had all sorts of time to dig into the latest act that was passed or signed by our president 2 days ago, the Inflation Reduction Act. I'm not sure if that's a really brilliant marketing title or if it really does that, but just from top of line takeaways for our SMBs, are there any kind of things that you glean from that act right out of the gate that will start immediately impacting businesses sooner than later, and that they should kind of keep top of mind?
Top of mind, they're going to spend $80 billion in beefing up the IRS. And they're going to take $45 billion of that in your market for enforcement. That's the biggest piece of this. So I've got a lot of clients right now that went really fast. Like Kellen said, there was a lot of capital, a lot of cash flow. So they started going, they didn't really think about their structuring, they didn't think about tax benefits, tax detriments, and they're running. Well, now they're going, my modeling doesn't really facilitate what I need to do. And they kind of swept under the rug because the IRS is so disorganized right now. Well, they're about to get their ducks in a row. And so if you haven't sat down and done an apportionment study or a nexus overview to see where you have potential triggering nexus events, or even from a structuring standpoint of how do I pay myself and my company without being taken to the cleaner or having to pay everything I make, or self-employment tax fully, like how do I leverage that? That wasn't a forethought. And so now we're having to go back and correct that retrospectively, and it's a lot more difficult. A lot of people don't like to think about tax because it's not fun to pay taxes, but you're going to pay tax or report something at some point. And that's what these new clients that are profitable, or they're actually going through a growth spurt, now they're going, wow, I didn't realize that we were going to have a 33% tax rate right now. What's driving that? It's like, well, if we would have thought about some of these inputs and variables from the front end, we could have mitigated 10 or 15% of that and not had to spend any money. That's the crazy thing, is a lot of these structuring things are elections that they just don't know about. Or a lot of these, analyses that we can do and save them 15.3% in self-employment taxes. You know, if you're paying yourself, you know, $250,000 a year, that's a lot of money. And it's just low-hanging fruit like that they didn't stop and sit down with somebody and really go, okay, this is what I'm thinking, this is where we're going. And I mean, outside of inflationary impacts, it's just the initial structuring and then the overall encompassing of, hey, let's do a catch-up and tell you what we're really doing now that we have time to sit down and really see where we're at. We're not worried about starting the company, we're actually moving forward. So let's get some tax consulting here planning.
So the restructuring component, that's obviously after the fact, and I know we see that weekly from people. Is that newer, or is that, have you kind of always seen a heavy flow of that, or have recent conditions necessitated that more so than you've seen before?
Maybe talk about how the tax code what that's looked like over the last 24 or so months.
That's probably
Yeah, and so the tax code in and of itself, and I will say inflation is the biggest impact that you guys are going to see from inflation coming up, is you're going to see SALT implications. So not so much from the federal, the Reduction Act didn't really hit a lot of personal people hard. It's really going to be a big corporate client, someone that's got over $1 billion profit. So you're looking at, you know, Walmart's, Google's, whatever. But they're still limiting passive activity losses. You know, you don't know how new equipment's going to be able to be depreciated if states are going to decouple going forward. You're going to see a lot of changes on the state side, and that's the hardest thing to track because they're always changing stuff. So you might have a state, you might say, okay, well, inflation's going up, so I need to go ahead and leverage now and buy what I can, buy the equipment, I need to automate, I can't hire anyone. Well, if that's the case, you might be subject to a Section 163J limitation when you can't deduct that interest on that leveraging. Or you might essentially not be able to capture that bonus depreciation that you would have been able to capture, you know, 2 years ago. So it does determine cash flow and purchasing to think about taxes before they happen. And that's just the caveat here is, you know, taxes are one of the two true things in life. And so by really getting in there at the preliminary stage, or even if you've already started and you're really late to the game, there's still a lot we can do, and a lot we do on an ongoing basis to kind of hedge these changes, because they're always changing. I would say now they've got to pay for all the money they've given out. So they're trying to figure out ways to do that, and not just from the federal side, from the state side. And to mix this all, you've got to pay yourself too. So you want to find the most, you know, prudent way to set yourself up to not have to remit taxes, but to also be able to pull money out and not be penalized for it. You shouldn't be penalized for success, and that's what we're trying to set everyone up for, is to be able to, you know, realize that.
So Leah, from an inflation standpoint and what you were seeing,
Yeah.
I'm a business and I was hiring for a cashier a year ago and a cashier today. Are you paying a premium on that cashier now that you didn't pay a year ago?
That's a good question. It may cost more for a cashier now, but that doesn't mean because you need a cashier so badly you should go in blindly. Because again, we are seeing kind of, you know, these fluctuations in the market, so it could potentially cost more, but we should still make sure we recognize essentially what's the business problem we're trying to solve here, and is this worth the value, like is this worth the cost of what this candidate is, essentially. And again, I'll bring it back to the value proposition part. So sure, it could cost a little bit more, right? So we should still be reasonable and have a pulse on the market to know kind of what the reasonable cost for different roles is. But you can also supplement. You shouldn't, you know, jump up and throw up $10,000 extra for this person, but you should supplement maybe that slight increase to the comp with really the value proposition piece.
I would also maybe ask this to all three of you, depending on how each of you want to answer, but would you say what Chaz has put together here in terms of this demand and services increasing, is what we're seeing a reduction in, it's difficult to hire, it's hard to find talent, are people starting to outsource a lot of the jobs they were hiring for internally because it's too hard to find them and it's too much to pay them? Are we seeing more of the outsourcing of those things happening, or is it a mismatch of we need to automate this, so we need to hire a developer to do this instead of
the cashier to do it because that's, we're gonna get more longevity and scalability out of that.
I'll answer it briefly and I'll pass it to Chaz as well, but it's, what we're seeing is people start, the light bulb is going on where people are realizing they don't need to own things, that they just need to have access to all the time, right? So, and that's what we do fundamentally, right? Is I don't need a full-time CFO. Maybe I need one 20% of the time, or really I just need to answer this one pricing because I'm doing that I've been hung up on for 6 years, right? So project work is increasing, automating and sort of outsourcing the daily recurring stuff and insourcing your strategic stuff is increasing as well. But, you know, if I had to put a nice sort of hippie title on it, I would just say you don't need to hire or really own things that you can just get by with access to. And one of the things that happens during sort of unsteady economic times is businesses, you know, not to issue another cliche, but do more with less, right? All of a sudden, people start to get more profitable and these trends shift. Very rarely will a big giant corporation raise its hand and say, you know, okay, we're through that. I'm ready to go back to doing less with more, right? They learn lessons of these sort of streamlining effects get ingrained in their DNA as a company, and then they perpetuate in the future. And that big trend is they're realizing, I don't need all these people. You know, it's hard to hire them. You know, I can't. We're talking about cashiers; those are robots now, right? That's the typical job that gets replaced. So we're seeing that, like, you know, CEOs are starting to catch up to that reality, and also they've had to. You know, people are working remotely. The gig economy is taking over. That has moved up market. It's not just your Uber driver now. Now it's your, you know, $1 million software developer that's going everywhere. So that would be my answer to that.
That's a good answer. I don't have a ton to add to that, but I want to hook on one specific thing that you had said that you kind of mentioned earlier as well. This is where, in that mismatch of jobs, this is where having too low an unemployment can be a little bit of a strain on the economy, right? At 3.5% unemployment, the most recent one, that at that point you can probably assume most of that's actually a mismatch. So in the sense of, hey, so-and-so's looking for a job, they know that there's available jobs, but that's not the job that they ultimately want. So yes, they are considered unemployment in the fact that they're looking for a job, but it's not the same thing, right? And that dynamic is very prevalent when it comes to that low of an unemployment rate. And I didn't really mention on it earlier, but some of the stats around the labor market kind of show an interesting dynamic that it may be around to stay. And really, when you think about the unemployment rate being that low, but we still have some pretty high jobs, it's really more so, okay, so where are the people? And that kind of leads us to a metric called labor force participation. And this has had a really fascinating long-term trend that's going on right now, because every economic cycle has these short-term trends and these long-term ones, right? The short-term one's a pretty straightforward one. When COVID happened, labor force participation went back up, and it basically got about, I don't know, we'll call it 4/5 of the way back up, and then kind of resumed its typical cycle, which is pretty normal for quick recessions. But the long-term trend is really fascinating. You really have to go back to about the 70s. 70s to the 2000s was one cycle, and then 2000s to now is the current cycle. So in the 70s, labor force participation was I think a little bit under what we have now, and it went up to 2000. It was at 67%. So we have this long-term cycle of increasing labor force participation, and we really see two large metrics that happen during that time. The first was the median age of the average of the typical worker went up an entire decade. So it increased 10 years. It was from like the late 20s to the late 30s was the median age, which is a pretty typical when you start talking about population trends. We have these kind of large population groups. So that was the baby boomers moving through, but you'll see it through history in various large population groups, right? The other fascinating thing is if you look at specifically with women, the increase from the 70s to the 2000s, there was this significant increase of women joining the labor force. At about 2000, the male and women kind of labor force participation started moving in the same pattern, which from 70s to 2000s, they were moving separately. The men participation was actually slightly going down, while really women were the reason that so much of the percentage went up. We then hit the 2000s, and we've basically been going from that 67% down to the most recent one of 62 for the last 2 decades plus some. So when you look at it from that side of things, it's like, okay, we're not talking about a short-term trend when it comes to the amount of people in the market. This may actually be something that businesses need to address. And to the point that you were talking about, there may be certain positions that you only need like half a person there. Like in our particular industry, like bookkeeping, monthly accounting, like a certain size of business just doesn't need that. But that's not exclusive to ours. There's a lot of different dynamics. Sometimes like from a marketing side of things, maybe you don't need a full designer. You may just need somebody that you pull from a freelancer or something along that lines.
Yeah, that makes sense. Those are pretty sound answers to my question. So before we kind of open it up to any questions here or in virtual land, I don't know if Jordan will have questions for anybody coming remote, but I have one final question for all of you from your various perspectives. We've seen, we're in client service and we service a lot of different businesses of all shapes and sizes and stages and industries. And we've seen a lot of people actually come through COVID not only surviving but thriving. And my question to you guys, if you had to boil it into 1 or 2 characteristics or differentiators about those businesses that come to mind that have really rode the wave effectively, what would you say made those companies, thrive in the way that they did? What would you say are those kind of factors?
Yeah, so I'll start on. I would say I would do a major and a minor.
Okay.
And that the major point, while kind of cliche, is very true, is the businesses that we saw grow the most and have the most success were laser focused on their value proposition. Because to the point of that, people recognize when that's happening. And when things start getting a little bit crazy in the sense of you have shutdowns and whatnot, all your strategic decisions from a strategy need to make sure that they're encompassing what that value proposition is. And when you're not laser focused on that, you get a lot of shiny object type of situations that they don't fully come to fruition, and you have struggles there. The other side of it would be just those that actually know the inflows and outflows of the business. When it comes to a financial standpoint, if the way that clients managed it, we're just looking at their bank balance at any given point and they figured out what their money spent, like that just doesn't work when it comes to a dynamic where you need to be very agile of, okay, we need to deploy this money to ultimately farther our value proposition, or no, this isn't doing anything, the software is just wasting our time, we just need to get rid of it. Where those conversations start is by knowing where those finances are.
Good answer?
Yeah, I would second that. Mostly it's discipline and not allowing your eye to be drawn away to things that don't matter, right? Because sometimes you have a business owner that is good at one thing, and if you're just a hammer, then everything starts looking like a nail after a while. And what you want to avoid is basically getting too seeing threats everywhere, seeing opportunities everywhere. You want to figure out what are the 3 to 4 KPIs in my business that really, really matter, and that I can draw a straight line from that to profitability, or from that to revenue, or from that to cost. And then you get laser focused on that, and then you want to show up every day. It sounds a little bit silly, but the businesses that we see fail, common thread through all those is absentee management, and people that want to start a business and they want somebody else to run it for them, and they don't want to show up every day. You got to be there. You got to be focused on what matters. You have to identify what matters, and then you got to have blinders on and ignore the rest, and fight your way with the shiny objects. Because you're going to, like I said, you're going to get 9 emails a day from some startup company that wants to sell you a subscription for something that maybe you don't need, right? So go through that, do vendor analysis, know where every dollar's going, but just be focused on OTS as your value proposition for me.
I'll come at it from a people perspective, naturally. Kind of to go on to what both of y'all said. So a company that can effectively, again, articulate their value proposition from a business perspective, but also to prospective employees and to their existing employee base, and then really live up to that value proposition. They're not just saying, hey, we're going to let you do meaningful work and work on cool stuff. They live up to that. They're leveraging new technology and kind of pushing people beyond what they would typically be comfortable doing. So that's first part of that answer. Oh, and the second part, I would say, from a people perspective, a company that recognizes, hey, either a company that's really clear on if it's something that they can handle internally or something that they either need to hire, or to what we were just talking about before this question, something that they need to strategically outsource or leverage external experts on.
Yeah, just to piggyback on all those great points. I see a correlated relationship. The people that are naturally doing better need more X guidance. But one of the common elements with that is, kind of like Kellen said, they're all encompassing. They know where everything stands. They know what they need to leverage to maximize their benefit. And then from a tax perspective, specifically, they realize the benefits of putting time into this at the forefront of decisions, whether that's M&A, business combinations, or whether they're struggling looking for financing, whether they're trying to hire, grow, or merge. They realize that this can change the landscape of all those transactions, and if not, at the front of their mind, can potentially limit their decision-making opportunities down the road. So, and that's just kind of the clients that we see that are going through this, that are doing well. I'm constantly noticing that they know the lingo, they have put the time in, and even though they don't enjoy talking about it, they do recognize the importance of it. And that's not a common trait. A lot of people like to do what they're comfortable with, and they don't like to step outside that comfort zone.
So that ability to develop the discipline to check those boxes each and every day is really, really important. And that's a personality trait that not everybody's born with. But we have some clients that are happy to stay off meetings and stay off the phone. One in particular, but he shows up to the meeting every week and he has good questions and he's done his homework. He's ready to roll. And it took a while to get him there, but we got him there, and now that business is doing better than it's ever done.
I didn't answer this question last time, but I have the lovely benefit of, I'm kind of the face of all the new people that we either decide to not partner with or partner with. So I talk to a lot of different businesses every week. And I would piggyback on all of y'all's points, but I would further say that the leader of the company is huge in how they run that business. And I can now almost pinpoint from just meeting that one person, whether that business is going to take off and continue to do so, or whether it's going to teeter based on that just style of person. And are they somebody that likes people that tells them yes all the time, or do they like people around them to tell them their baby's ugly and be honest with them? Those people are a lot more fun to work with and partner with, and typically we help them almost instantaneously, and they're better for it. But I would also say too, the leaders that hire well and trust the experts that they hire to do the job and not micromanage them, but know when to step in, know when to take credit for the bad things and let other people take accolades for the good things that happen. You just see the infectiousness of how they lead, and I've definitely noticed that just some qualities about leadership have really been interesting to pinpoint as commonalities in our favorite businesses or clients that we work with. So I'll add to that. Does anybody here have any questions for us? You can open the floor to anybody here, or if we don't have any questions, then we can just kind of let everyone. Jordan, do you have any questions from the digital audience?
I don't have any questions yet, so I'll open it up to the room first.
I've got a question. I'm a firm believer that no two recessions have the same thumbprint. Having been through 2011, 2007, here we are today. There have to be rules to play the game. One thing that I don't hear in the media that I listen to is eroding profit margins. What are you guys seeing with that? What are you consulting your customers on? What do you advise them on? What are you seeing happening to those? Is inflation increases? Expenses go up? People, goods, the expenses that are involved in business?
Yeah.
Talk to that a little bit.
Yeah, so we are seeing profit margins did decline, but a lot of businesses managed to make that temporary and somewhat transitory in that, like, it's mostly people cost, to be honest. And so the people cost goes up, profit goes down, and they're figuring out almost like a zero-based budgeting standpoint is, did I actually need that person? How long can I go before I replace that person? They're starting from zero, a lot more bottom-up budgeting. Like, what are the exact dollars that have to go out the door to support the business as it is today and as it grows 3 months, 6 months, a year from now? They are not making no assumptions or preconceptions about replacing any staff whatsoever. And so there's a lot of natural attrition in that people can job hop a little easier than they used to, but some of the more disciplined companies are actually sitting down and coming up with a 3 to 6 page business plan on their chief technology officer and how do we avoid spending this cost over again, and how do we hire an MSP provider to do that on just a fractional basis. So we are seeing margin decline, but we are seeing improvements kind of in the short term after that because people are figuring it out, they're getting creative. If they're not, then they're just surviving. And so that's kind of what I get back to the zombie companies, the businesses that we have that aren't figuring that out. Their leverage ratios are skyrocketing. They're sitting with $2 million EIDL loans and really nothing to show for it. So one of the KPIs we designed is government debt in relation to current cash or current assets. So if I've got a business that's got $500,000 in PPP loans and then $2.5 million in EIDL loans, so they've taken basically, effectively $3 million of free money from the government, and they've got $800,000 in their bank account, then that's problematic, right? That's a lack of discipline. And so they've got really nothing to show for all that free money. Alternatively, we have businesses that have that government debt, and now they're sitting on $5 or $6 million in cash. So they've used it either as a lifeline or rocket fuel. And the ones that were able to be really disciplined about what's a shiny object and it's not, improved forecasting in their business model, whereas others have lost focus a little bit and relaxed and kind of calmed down because, we have this free money, so we have to pay it back for now 30 months. It's on the ITL. So it's all back to discipline. So the businesses that are sort of being put upon by inflation and having declining margins are going to be fine if they're being operated by disciplined operators, people that know their numbers and know their KPIs and know what their value proposition is. If not, then they're going to survive a little bit longer. In this case, a lot longer because there's free access to capital. That's one.
Yeah, and from a tactical standpoint, really kind of two areas that I've been dialing in on calls. One being, obviously we mentioned the pricing side of things earlier, but there's certain times that you can't just directly increase because the customers aren't going to take it. But okay, how can we potentially change the pricing structure? So for instance, going from a retainer model to let's do a package model that includes other resources like a help hub or something like that, some sort of educational content that enhances the perceived value of it so that you can get additional profit margin on that without scaling up additional resources depending on the business type. And then the other side of it, to what you alluded on, was, okay, people costs are going up. Is our current operating structure the way it should be? Or is there ways that we can maneuver the same people within here with the higher costs in different ways to be able to more efficiently handle the workload or the production, that side of things? Those are the two first strategies that I'll go into when it comes to that, and then kind of dive in farther.
And there's minutes everywhere in productivity. Like I'm trying to figure out how to auto archive any email I receive that just says thanks, because I get 40 of those a week, right? So there's little moments of automation that are available to you, and that's what people are trying to do. They're trying to figure out, how do I not, like, this client declines every price increase, they decline every scale up. They call me 8 times a week, like, they gotta go, right? So you gotta get rid of stuff like that so that you can focus on what's really driving value to your organization.
Thank you, Andrew. Good question. Anybody else? We have, by the way, beverages after this, if you guys would like to stick around and chat with anybody here, whatever you want. And also, QR code will take you to our website, where you can, in the forum, if you want to just chat offline with us a little bit more about any of our services, or kind of just poke around and see what else we do or don't do. But thanks to everyone here and virtually for joining us today. We really do appreciate it. And thanks, Jordan, for organizing. This was fun.
Thank you, everybody.
Thanks, y'all.
Appreciate it.